We got new data about where tech startup valuations are. Here's a hint, not up. And what are strategics doing who might want to look at buying these companies? At the end of every quarter, you kind of do your kind of like mark to market, hey, here's what we think, because these are all illiquid private investments, right? So, but you need to, at least on paper, update what you think the value is of your fund and of your investments, right? If you're a venture capital, or if you're a private equity investor, or you do real estate, or other illiquid kind of private assets that aren't as easily priced. You need to at least look at what you think that what those investments are worth on paper. So in Q1, more than 68% of venture funds suffered a drop in total realized and unrealized returns versus capital invested. Oof. Ugh. That take the air out of a lot of people. Of those funds, the median decline is 3.5%. From 2021's peak in terms of, that's not that much. That's the median though, not the average. And to put that in perspective, that decline is still very big, considering this is all of them, right? That decline is surpassed only by the downturns during two periods of recent events. The global financial crisis, which hit 7.8%, right? So we didn't just have a global financial crisis, you know what I mean? Like, this was Q1 of 2022. Things were just so high in 2021. We had $10 trillion printed and injected into the economy. We called it on the show. Not only did we say that we have real inflation, but we absolutely called asset price inflation long before anyone else was even willing to agree that there was asset price inflation. So I think there's more to go, 3.5%. Compared to, again, 7.8% global financial crisis, that's in 2008. And then .com crash was 15.7%. So we are not done seeing this. Again, these Q1, as we did another video talking about the lag. And so the Q1 data doesn't actually show the full story. There's more to go. We just closed out Q2. So in another month or so, you're going to start to see that data trickle in. And that data is going to be, I think, by and large, even worse. I think you're going to see an even bigger drop than 3.5% in Q2 here. So 68% with markdowns of VC. That compares to 54% from private debt funds, 52% from private equity funds. And so VC, they're winning this. They're winning this race, unfortunately. And then you look at the median downtick. Private debt and PE had a 10 basis point decline, so 0.1% decline, as compared to VC at minus 3.5%. Right? Not good. So now you say, well, in the beginning of this video, or in the beginning of our episode today, I was saying how a lot of people can still thrive even though you're in a recession and the economy is in a downturn, us included. And, what Applico does is we help large enterprises strike partnerships and do deals with tech startups. And so, fortunately, we did not help our clients buy companies at, maximum peak valuation. You're welcome, clients. They probably wouldn't be a client anymore if we did. And instead, now this article here is saying, hey, strategics think that startups have more to go in terms of decrease of valuation. And I would say that's 100% correct. The VCs may not think that. VCs are telling their startup portfolios to look at potential sales. And they've got some quotes in this article about that. But then the article is saying, hey, anecdotally, we know VCs are telling their startups to look at that, but the data actually doesn't show that. So what's interesting is here's what the data is showing is the actual amount of strategic acquirers. So these are strategics. These are, enterprises, corporates buying VC-backed startups in the US. That number actually peaked in Q4 of 2021, a little over 300 deals that closed in Q4. Now you got to remember, there's a lag here, right? So for a deal to close in Q4, it had to start in Q3. So now what you're seeing though is the closed count in Q1 dropping to 260. And now in Q2, this is as of June 24th. So you still have a week or so of data to go. But as of June 4th, you're at 192. You're not going to certainly make it back to 260. So maybe you're around 200. It peaked at 313 in Q4 2021, then to 260 Q1 2022, which was pretty much still a banner number ahead of where in Q4 of 2020, you had 245. Was the number of closed transactions in Q4 of 2020. So 260 in Q1 of 2022 still beats that. Now we're down. Now we're going underneath where Q4 was. Now we're kind of in the territory of where we were Q3 of 2020 with Q2 here, maybe at 192, 200. And so to me, what this means is strategics are taking a step back. You still now haven't seen, right? Like the Q3 number is going to really start to show you once strategics could look at where deals were at in end of Q1 and into Q2. Yeah, I don't know. Hey, VC money is drying up. Interest rates are going up. Startups are going to have a tough time. Let's wait before we really go buy someone right now, right? I think this Q3 number is absolutely going to drop from where it is in Q2. You could say it's going to drop below the low. So the low for the past 5 years was actually 163 deals, and that was in Q2 of 2020. That was the low. So will it go to a 5-year low? It might not. And here is why, is because we're not talking about total dollars spent. We're talking about total deals closed. So I know I'm already seeing it just anecdotally in the work that we do. You are seeing a number of startups pick up the phone and say, hey, so would you be interested, right? So this is total deal count. I do think you're going to see now a lot more inventory come online. You really need to have cash in the bank for the next 2 years if you want to live through the next couple of years comfortably, right? What are the best startups going to look like? They got cash in the bank for the next 2 years, or they still have really strong growth and they're not losing too much money, where they could go, maybe they didn't do their raise in the past year or so, but they still could pull off a raise. They're going to get whacked in terms of valuation, but they can still get the cash they need to make it through the next couple of years. And they could still go do that raise like later next year or early next year, right? So for basically all the companies that don't fit into that category, they're going to need to look at door number 3, which is making some uncomfortable phone calls. These strategics are smart and they understand. I mean, they're in the business. They can see it in their own business, what's happening and how much demand is softening, which means that if you're a startup and you don't have some nice cash reserves and your growth isn't exactly where it needs to be, or your burn's a little bit too high, yep, you got to, make those phone calls, right? What's the harm in making the phone call? Someone says no. Okay. What you don't want to do is not make the phone call and wait another 3 or 6 months where now you're talking about bankruptcy, right? Whereas if you got out in front of this, because what you have to understand is for strategics to do deals, it takes a lot of time. It takes a lot longer than, a high-priced, flashy, big tech acquisition. Actually, frankly, it actually takes much longer because you are now going to a strategic that maybe they weren't already thinking about why to do this. Why is this a priority? These large billion-dollar companies, right? They have a plan. And if you don't fit into that plan and you want to just kind of say, hey, I'd be a great thing for you to buy. Should they take time to pause and divert resources to something that wasn't already on the roadmap? If it was already on the roadmap, they're already talking to you, right? I mean, worst case, even if you don't need to actually go through with the deal, then just don't sell it, right? Like maybe you do raise that fundraise and you don't need to sell. Okay, good for you. But, what I say is you don't want to wait till the last minute. Don't care about optics and all this kind of stuff. Oh, they're going to judge me because I said, hey, I might be open to, right? Honestly, none of that matters. No one really cares about that. And you got to just it's time to make the tough phone calls. That's what time it is. No other way around it. We have not seen anything yet. Let me show you some data here from real estate. You're seeing something similar happen in real estate, which is crazy. Look at this stat. Active listings percent change from prior month. This is May. This is May data, May of 2022. This is for real estate now. 25% increase. 25% month over month increase in active listings. Why is that? It's because a lot of people in this country are smart. They can see economy is not hot. Apparently they can see that better than Jerome Powell. God, it is just too easy to take shots at that guy. He sets himself up for it. 9 days ago, he says there's no recession. Excuse me? 25% increase in active listings. Look at the data, right? In February of 2022, you had minus 15%, which means, right, there's less active listings from the month prior. In January to February, there was less inventory online than there was the month before. So more people buying, not as many people adding inventory to the market. Now you got 25% increase. What you're seeing is people realizing, hey, I don't sell my house now, I'm not going to be able to do it in the future, right? Or if I do, I'm going to take a much bigger haircut. I'm not going to be able to maximize the price for the house. That's why you're seeing this rush of new inventory coming online. I think it's the same thing you're seeing. There's no way to look at like tech startups for sale. There's no data point for that, right? You can just kind of see what's closed, right? But if you want to say, hey, who's putting their hand up? I guarantee you it's the same stat or very similar, right? It's now everyone's saying, ooh, this ain't going to be so good. Interest rates are going up. Not going to, right? The mortgage on a house is already going through the roof. It's only going to keep going higher. It's only going to keep raising interest rates because inflation is uncontrollable. Still not going down. Talk to my B2B distributors all the time. It's still not going down, gang. And the stuff they see is at least 6 months out from the time it gets to the consumer in the actual inflation reading. Inflation's still going up. People have figured it out. People are smart. They can say, oh, once the data really comes out in real estate, and for example, the Q2 data, once that data comes out, which again is lagged by a few months, and you really understand, that home prices are coming down and the deals that are closing are now closing for less, but there's a lag on that data. We haven't seen that data officially reported, but you can look at the signals. And the signals in the market are saying, yeah, if you haven't sold that house and you kind of need to sell that house, or you sell the house like right now. Sell that thing in July. Because this data is going to start to come out more and more. You're not going to get the same price you could get right now. You're not going to get the same price that you could have gotten 6 months ago. If you like this video, go check out the video where I flipped an Escalade because of this same exact dynamic, but in reverse, right? We were living in upside down land. Go check out that video.